folks. I'm Sam Chandan, the Silverstein Chair and Dean of the Schack Institute at the NYU School of Professional Studies. Thank you so much for joining us again for the REIT Leadership Series. The series has been an extraordinary success. As you hear from me in my preamble each week, we kicked off with Sam Zell on July 8th and have had a different REIT chairman or CEO or C-suite executive almost every week that has followed. Turnout has been amazing. Between the live sessions and the replays, we've reached about 35,000 people now with the series. So we really couldn't be more thrilled. Made a decision in August that we were going to continue this through December at least, and have my fingers crossed that we can kick the series off once again in 2021. Thanks again to Mike Landy and to the folks at Monmouth for sponsoring the summer series. We were able to use those funds to support students whose families' incomes had been disrupted by the pandemic. Made a big difference for some of our students, and really appreciate that. Monmouth and Mike, of course, are hugely supportive of the Schack Institute, as are so many others, throughout the year. But coming in this summer was especially meaningful for us. If you want to learn about how you can sponsor this series or any other program, we do use those funds to support need-based financial aid. Please get in touch with my office or with Michael Foote, our Director of Development. And one of the reasons that we've opened this up so broadly is that we want to make the opportunity to hear from REIT CEOs available to students no matter where they go to school. We realize that academic institutions across the country have been disrupted in terms of their ability to offer meaningful programming for their students. So from a mission perspective, certainly for our own students at Schack, but we wanted to make sure that this conversation was one that we could make available to students at any institution. And so we do appreciate everyone's help in getting the word out. And I should say that the majority of our attendees are industry. So welcome once again to the series. It's my privilege to co-host this each week with Adam Emmerich and Robin Panovka, the co-chairs of the REIT M&A practice at Wachtell Lipton. Both are members of our REIT Center board. Robin is also a member of Schack's board. And Scott Robinson, who you will see in just a little bit. Scott is a great friend and colleague to me, and a faculty member at the Schack Institute, the director of our REIT Center as well. We've had some amazing guests. The replays are all available with just a couple of exceptions on our YouTube site. That's youtube.com/NYU Schack. You can hear from Hamid Moghadam, Debbie Cafaro, Sherry Rexroad, Hap Stein, just a really long list of amazing folks. And in the chat function, I'll repost that link. Given the success of this series, we've also launched one focused on the capital markets. So every Thursday from 12:30 to 1:30, we have the Capital Markets Leadership Series. This Thursday, we'll be joined by Tammy Jones, the chair of the Real Estate Executive Council, the premier organization for minority executives in the real estate industry. She is the CEO and co-founder of Basis Investment Group, a major multifamily lender and investor in the United States, and also recently appointed a board member of Matt Calley Realty. So we're looking forward to hearing from Tammy as part of our Capital Markets Leadership Series this Thursday, and I will post a link to that, to that series as well. Just as a reminder to everyone, please use the upvote feature in the Q&A. Post your questions there. Vote for the ones that you like. I'll make sure to come back at around 1:15 Eastern time to put some of the most popular questions to Glenn. But with that, for a proper introduction, for those of you again who signed in a couple minutes before we started, this is a treat for me. Glenn has been a huge supporter of the Schack Institute for as long as I've known him, and certainly long before that. He is one of the first people that I had the privilege of meeting when I came to Schack. I started in the spring of 2016, a novice from West Philadelphia, and didn't know a lot of folks. One of the first major events we hosted was our Urban Leadership Dinner. And Glenn, this is sort of an award that Larry Silverstein established for us in the early 1970s to really recognize someone who's made an extraordinary contribution to the advancement of the real estate industry. It has made an extraordinary impact on the communities in which he or she is investing and developing. And it was such an amazing experience for me to meet Glenn, the recipient of our 2016 Urban Leadership Award. But for an introduction to his work at Vereit and everything else, I will pass it over to Adam. Let me just share this poll with you. 49% of here we are. 49% of respondents have not returned to work at all. They remain fully remote. 23% of folks responding to less than 10% of their company staff, and I apologize for my typo, are in the office on any given day. Only 6% of respondents report that their companies have returned to pre-pandemic patterns of space use. Thanks for answering that. It gives us some food for thought as we head into today's discussion. Adam, let me turn it over to you and Glenn.
Thank you so much. Glenn, thank you as well for being here today. I don't want to take time away from the audience's opportunity to hear from you. I'll briefly mention your unbelievable resume in real estate. You've been CEO of the company that's currently called Vereit since 2015. And you've really affected a remarkable transformation of that company. We'll talk about that in a little bit. You've been on the boards of, I think, companies in pretty much every sector of real estate. It seems like some of them, you know, the leaders in their field: Ventas, Columbia Property Trust, Trizec, Crimi May, and GGP, among others. You were previously the CEO of New Plan, as well as Centro. You were the CEO of Cushman and Wakefield, and you've been active as a money manager and a property developer at O'Connor Capital Partners in at least a couple of different interludes during your career, starting in 1983 when you were one of the founders of that firm. So you've had a fabulous career, and you've done a fabulous job with Vereit. Why don't we just switch right away to talking about that, a little bit about both where the company has come over the 5 years that you've been at the helm, and also particularly where you've been steering the ship since the pandemic began. You've had some of the best rent collection numbers in the sector during the pandemic. Tell us, how have you done that? Talk about diversification if you have a minute. Tell us a bit what's going on.
Well, thanks, Adam. Thanks for that very kind supporting discussion there on myself. And when I often hear all those companies, I say to myself, I just couldn't hold the job, and so I'm hoping to keep this job a little longer. We did start here, and it's called Vereit. It was called ARCP before that in 2015. And to your point, in the second quarter, we had 86% collections, and as of September, we actually collected 95% of our rent. So we've had good collections in a very difficult period of time. I'm going to go backwards. The reason for that is where we started. Where you start is where you end. If you start right, you could end right. If you don't start right, you're dead. What we did early on in this company, in the portfolio, and we always focused on the portfolio number one. A lot of people had asked early on, when we had too much debt, we had litigation by the SEC and the DOJ, as well as opt-outs and civil suits. With all the issues we had, what was the number one point? And the number one point always is, if you collect rents from your tenants, you'll do okay. And we focused on that early on. And we did that by outlining what we wanted the portfolio to look like in 2015. Our first report to the market on a business plan was in August of 2015. And what we said is, here are the statistics that we're going to put around this portfolio. No more than 5% of the tenant 10% in an industry, 5% in an MSMA from a geographic standpoint, 30 to 40% investment grade, approximately 60% retail, 15 to 20% office and industrial. And we made sure that if all those statistics work, we had a fully diversified portfolio. Now, at the time, we did not. As a matter of fact, we violated a whole bunch of those principles that we said we were going to adhere to over time. But to get there, we sold $5 billion of assets in the last 5 years, and we bought $2 billion of assets so that we now fit all those metrics. Luckily, or thank goodness, because it's at this point where those metrics, those diversifier metrics, have put us in a position where we in fact can collect 95% of our rents in a very difficult period. And you know, when I hear myself saying that, I always say to myself, before March and April of this year, we always assumed we collect 100% of rent. Why would you even consider not collecting 100% of rent? That's what we do. That's what our job is. But it became difficult, and that diversification is what got us there. You know, for instance, when we say we don't want any tenant or any credit more than 5% in our portfolio, we started out with a credit at 12% in our portfolio. Red Lobster. You know, we got them down now to 4.8%. We didn't want any more than 20%, 15 to 20% in office. We were 24%. And we've sold $1.8 billion in office out of that $5 billion. So we were very disciplined in how we looked at the metrics that we wanted to have, and we eventually got there. And that's what say this. I've had a number of questions, and this pandemic has proved my answers were not so bad. People would say all along here, well, which is the best property type? Is it retail? Is it office? Is it industrial? And our answer generally was, we're not smart enough to know that. What we do know over time is that there's change, and sometimes that change is secular and sometimes it's cyclical, but it's coming. And if we're diversified, we have a better chance of dealing with what's ever coming. And the pandemic came. So we are happy with the diversification we have and our ability to work with our tenants to collect rents.
And it seems like you're obviously, I'm sure you're hoping to get back to 100%, but you know, you're very close, and it feels like, do you see kind of a glide path or a trajectory of getting back to 100%? Well,
you know, we would hope so. The question is of the tenants we have, and this is a question we all have. How many are going to have difficulties which they're not going to be able to overcome? And there's going to be some of that. It's just the nature of what we're doing. The duration of this pandemic is a really important factor here. And you know, I know we'll talk a little bit about the economy and what could or could not happen, but duration is the issue. And if the duration continues and some of our tenants continue their problems, we'll have some issues with our tenants. And what we'll have to do is take back some properties. We'll release them or work with the tenant on some longer term basis. And ultimately, we absolutely want to get to 100%, but we're not naive. We know we're in a pandemic where some tenants are suffering. Some tenants are doing terrific, by the way. We have a bunch of essential industry groups that are doing fantastic. But we have some tenants that, whether it's in casual dining or entertainment, that are going to take a little time to come back.
Yeah, you've talked about that a lot in terms of with investors, in terms of your goals as a management team and a company for managing during the pandemic. And I think you've said there are four things that you've been focused on. You touched on one of them at least already for sure, which is number one, keep employees safe and create a productive work environment, recognize tenant challenges and work with them. Maintain the progress you've made in diversification and the portfolio structure, and keep growing AFFO through your business model. Just focusing on the first one for a second, can you talk a bit about your own team and how you've managed through this pandemic crisis?
You know, it gets back to philosophy, whether you have a pandemic or you have a crisis at all. I have a pad right here that for a mouse, and on that pad, it talks about our business approach. And what is the Vereit business approach? And our business approach, regardless of the timing, is to be disciplined, consistent, and transparent. And those three principles have to hold whether we're in good times or bad. As we sit here today in the pandemic, we insisted that we look at those three business approaches and abide by them. So discipline, for instance, very, very important. We went remote March 16th, which was a Monday. By the way, on March 17th, I started to have a fever and came down with COVID.
You seem like you've made a full recovery.
I'm fine today.
Glad to hear it.
What it really meant is that, your business approach has to work with the CEO in place or not. And so we, from a discipline standpoint, we implemented immediately phone calls and or videos. We used Blue Jeans instead of Zoom, where certain departments, where the management team had to talk to each other, the senior management team every day. Certain departments had to talk with other departments every day. So we scripted on an hour by hour basis for a week the meetings that had to be had via video conference or on a telephone, just so that we would know there's communication, which is the problem with this pandemic. How do you communicate as well out of the office as compared to being inside the office? So discipline was very important. Consistency was very important. How we processed our queue and how we processed our supplement and our investor presentation and our board books. We had to process them the same way remotely, but they had to be processed the same way. So we had accuracy and dependability in them. Transparency had to be there. We had to make sure we're talking to each other. You can't hide anything. What it's so easy when you're in front of someone to say, hey, tell me what's going on. It's not so easy in an email or the phone. So we had to be transparent with each other in order to ensure all that. Besides having those phone calls, as I mentioned, every 2 weeks we had a town hall where all the troops were brought in to talk about what's going on, and then I would also try to make sure, and I continue to make sure that I call people. How you doing? What's going on? How you feeling? And so you need to somehow plug a gap, and the gap is communication when you're remote. And we have found we've been able to plug that gap, but it's very difficult. And it's just based upon what we just saw on the screen in terms of 49% of the people being remote. I've been asked, and I'm sure CEOs all over the country have been asked by their boards, are you efficient remote?
Mm-hmm.
And my answer to the board was, that's not the right question. The question you should ask is, are you getting the work done? Yes, we're getting the work done. Are we efficient? No, we're not. We're not. You cannot be efficient from a communication standpoint, in my view, if you're not together on some frequency. You certainly can't educate the young people who need to be uneducated as part of being remote. So we're not as efficient, but we're getting the work done. We've been voluntary. All our offices are open. We have about 160 people. We've been voluntary since we probably opened the offices whenever we could from a governmental standpoint. Mm-hmm. Whenever the governmental authority, whether it's Phoenix or New York or Chicago or Texas or California or Florida, allowed us to, 2 weeks later, we opened up. Mm-hmm. We allowed 2 weeks in between. Yes, you can open in an opening, but it was voluntary. Mm-hmm. As of last Friday, we are going to ask people to come in 1 day a week in all our offices, starting 2 weeks from last Friday, or actually 2 weeks from this Monday, so that we can get people comfortable. But we want them to be safe, and we put all the CDC programs in place. When you walk in our offices, you have a temperature kiosk that you walk through. So we believe we've created a safe environment, and we want people to start coming back, but feel good about it. And all of that is involved in keeping your employees safe and a productive workforce, because ultimately we've got to get to the workforce coming in. We may be more flexible in terms of the work environment, but we eventually need to get back to people in the office.
In terms of all the other kind of interactions, and obviously, it's interesting. One observation I had, it's not probably very scientific, but you're a CEO who was infected with COVID early on. CEOs seem to have been a uniquely vulnerable population in my small little subset of experience. I can't tell you how many CEOs I know who got COVID, and I think it's because you're out and about so much, dealing with analysts and customers, tenants. In all those other interactions, after you recovered, thankfully, and got back onto the Zoom and the phone, have those interactions also been? Have you been working harder on them? You think you've gotten to a point of getting the work done, even if not efficiently? Yeah,
we have, and maybe your example of CEOs getting COVID is because we're not bright. I'm not sure. Maybe we just you just plunge ahead and don't think. Sometimes you talk before you think, and sometimes you act before you think. And maybe CEOs acted a little quicker than they should have. And didn't think about COVID, but yeah, I actually was not in good shape for a while, and put out an 8K, as you may know, Adam, to the market and said, I'm out of business here, and Paul McDowell and the management team are going to run the business until I get better, and they did a terrific job. The business rolled on the way it should have. Those business principles were used, and the business was fine. I came back in a month. I was out for 30 days, and was able to fit back in, and the team is doing a good job. We do get all the work done. As you know, we're in the process now. We go on the Horan on November 5th, so our earnings release is that morning, and then we have our call, and we're in the process of board books and Qs and Ks and investor presentations, and we're all in sync and in good shape.
And you've done deals also during the pandemic. Could you tell us a little about that? You did a deal with almost 2.5 million square foot distribution facility in Dallas for $250 million. Was it? How did that deal making during the pandemic flow for you?
Well, that was in a partnership. As you know, the business model we've created is that we can use public capital, but we can use private capital as well. We have a partnership on investment grade industrial, which has been a property type we love, but very expensive. And we found the best way to acquire it is with an institutional partner. We have a partner from South Korea, KIS. Now that deal started before the pandemic. It's roughly $250 million. A 20-year new Home Depot project outside of Dallas, and it flowed right through the pandemic, and we were able to close it about a month and a half ago. The question mark there, I think, to your question, is a couple. Was it financeable? Absolutely. If you have an investment grade tenant with a 20-year lease, we didn't have much difficulty financing it. Although I would say there was clearly a bit of a slowdown in the second quarter, but a resurgence at the end of the second quarter, third quarter in debt, and a larger resurgence, in my view, in terms of deals coming to the market after Labor Day. Mm-hmm. So I think we're in a full-blown market right now. But for that deal, there was debt available at attractive rates. We closed the debt. Did the pandemic affect the price? Not greatly. Would I would have liked it if it affected it more? Yes, I would have liked it at a bigger discount. But I have to tell you, when you have a 20-year lease with an investment grade tenant in a brand new building in a good part of Dallas, even in the pandemic, that was a very sought after product. It's almost like people running the treasuries. If you're going to buy real estate, it's a pretty safe investment. Yeah. And so there wasn't a lot of as much negotiation as we would have liked on the price, some, but not a lot. And we were able to close it through the pandemic. And in terms of the market now, I pretty active. Just as some, we paused a bit in the second quarter to get a sense of the market, to understand price discovery and so forth, understand credit. But it's pretty well understood now. Pricing is the bid ask that you may have had in the second quarter is closing very quickly on certain real estate.
Yeah. Do you think that we've kind of caught up whatever people might otherwise have done in the second quarter? That's now sort of, there's been a bolus of activity that's been more than usual, and we've sort of caught up, and going forward it'll be steady state as it was pre-pandemic? Or do you think there's kind of a flood tide coming, or neither of those?
Well, if we're going to find out we'll find out in the third quarter. You know, that there'll be activity that will be discussed. You know, we Agree Realty, a very fine company, just announced yesterday they had a pretty large fourth quarter acquisition program, well over 400 million. And I give them a lot of credit. They've done a terrific job in their balance sheet as well as with their credit in the portfolio. And we'll find out how others will acquire. But it'll be different for different property types. I'm going to bet shopping centers and malls, you're not going to see much acquisition activity. You'll see acquisition activity in net lease. There may be some acquisition activity in multifamily, and perhaps certainly in industrial. But it's going to depend on property type, and it's going to depend on the ability to underwrite credit and the availability for certain sectors to have a cost of capital that works.
Yeah. Yeah. Interesting. Thank you. Let me touch on a completely different subject, which is, functioning as a public company. The REIT sector has obviously seen a huge increase in size over the course of your career, and continues to look very robust. The public company sector, more generally, has contracted very sharply in terms of number of public companies and concentration of market capitalization in behemoths. If you look at the S&P 500 and so forth, do you think the REIT sector will continue to exist as it does now? Do you think we'll see concentration, a smaller number of bigger companies? Any predictions along those lines?
Well, I've been wrong on this prediction for my whole career. Because I started in the public market in 2000 with Newplan, as you mentioned. And back then, we had Sarbanes-Oxley fall upon us, if you remember, I think it was 2001.
Yeah.
And put some regulation on us in terms of how we had to support our numbers for SEC purposes and report, which I agreed with, by the way, because if you don't have a shareholder base that believes in your numbers, you don't have a shareholder base. So I'm not objecting to Sarbanes-Oxley, but I remember in that year it cost us about $1.5 million to put in, and,
yep.
and it ran about $750 to $1 million a year to administer 401. So I became convinced that larger was better for a whole series of reasons, including running the G&A of a company, and therefore thought there'd be more M&A. And from 2000 till today, what I have found is there's been, in my view, far less M&A than I would have thought. But if I were to ask my investment banker friends who are out there every day trying to promote it, and you love that stuff too, because they bring it to you, Adam, to close up, they would tell me that the reason it doesn't happen as much is not the economics, which is what I always look towards, but social issues. And the social issues in terms of whether people want to merge are important, at least I have found, as just pure economics of whether they should merge. And I'm not sure that's changing that much. I mean, maybe a bit. So even I would thought in public real estate, as compared to other forms of public, that we should have larger companies. But by kind of the very nature of our business, you would think something like this would happen. You could be your economic model could be a smaller company, not diversified at all by the nature of being small.
Yeah.
But you have a small base to grow from, and investors love that. And so you either increase AFFO internally or externally, and you grow, and that's great. But at a point in time, now you're getting larger. You got to diversify. A large company needs to diversify because you can't put all your all your eggs in one basket. And so you would have thought there's a natural economic model that would cause real estate to merge as well. But I've been wrong there as well. And so I would predict maybe the pandemic will cause some more mergers, perhaps, because there may be some weaknesses in portfolios that could be overcome by merging them with others.
Yeah.
But it's too early. I think if you see this as well as I may think about it, you're out there working on deals every day. But my sense is if there's going to be more M&A, and again, I'm going to say there should be, just like I have for 20 years and been wrong, it will probably be beginning next year. Once there's a better understanding of the duration of this pandemic. Because one other factor in M&A, which I also find is important, is if it's very difficult times and stocks are down, people believe their stock should be worth more, and so they don't never want to do anything. And then when stocks are really high, people believe it's going higher, and so they don't want to do anything. So there's this period in between those two time frames, and sometimes it's overnight and you're asleep and you miss it. But there's a time in between those two economics models or economic conditions where it's very good to merge, and maybe that's coming sometime next year.
Well, we'll see. I certainly can completely concur with your observation that the time to merge is a rare time, and the stars have to align.
Yeah.
One thing in the public company world that people have been talking a lot about has a kind of a number of different facets to it, whether you call it corporate purpose, stakeholder interests, ESG. Has that kind of mishmash of thoughts or ideas or movements impacted you and your role as a CEO of a public company and your relationship with stakeholders and investors and with your board? What's the impact been in Vereit?
Well, in terms of the stakeholders, I'm going to start out. We also have something we call the corporate commitment. It used to be called the mission statement. If you remember, in the olden days, you and I would call it a mission statement, but the new young people call it a corporate commitment, and that's what we conform with. So we have a corporate commitment, and the corporate commitment here is to serve to the best of our ability our constituencies, and we define our constituencies as three: our employees, our tenants, and our stakeholders. Unless all three of those constituencies are generally satisfied, or generally not satisfied a little, but consistent, we have a problem. We have a problem. So we've got to serve all three of those, and by stakeholders we mean certainly our equity, but also our bondholders and our preferred holders in our case. So that's how we think about our corporate commitment as a company, and then. We talked a bit about our employees. We talked very little about our tenants, but now if we go to our stakeholders, you mentioned ESG, and the ESG, our stakeholders are becoming more and more concerned about making sure they understand ESG and how we understand ESG. So yeah, that is a major issue for us that we believe in, by the way. I mean, ESG, the environmental, social, and corporate governance, have always been part of real estate, whether we liked it or not. We always cared about all three, especially in public, and whether it's ISS or the rating agencies or our institutional owners who own our stock, they are becoming more. That concept is more and more important. In fact, we have created internally an ESG committee. We have a chairperson of that who happens to be our general counsel, Laura Goldberg. And then we have each of the E, S, and G has a leader reporting to the chairman who reports to the board twice a year. And so we have a governing body for ESG. We have quite a bit of information on our website, and we do the best we can with all three. The S and the G are for us easier because by the nature of our real estate, it's primarily triple net single tenant, where we have little control, frankly, of the property. But we are doing our best to conform to as much as possible on the E. On the S, we do quite a bit, in a number of ways through our HR group, working with others, including diversity studies and pay studies, gender pay studies, to make sure we conform to certain requirements that are board mandates, not the outside world, that we as a company mandate. And then on corporate governance, I think we've been really good on that for a long time. I mean, we have majority voting, proxy access, shareholder rights plans, and no staggered boards. So, for a very long time, we've been very friendly from a corporate governance standpoint, would continue to be. But these are important issues that are going to be more and more important as the years go on.
In terms of sustainability, which obviously is something that is an attribute or not to some extent of all real estate, depends on what its purpose is and what its vintage is and so forth. Is that an area where you're getting greater focus, including from your own investors, from communities? How does sustainability fit into your underwriting process of properties, of tenants? Is it an important factor in the way that it didn't used to be?
Well, it's part of the E, right? I mean, it's a big part of the E, and it is more important. For instance, in every transaction, we have a section on climate control and how we will climate factors over time. And how they will impact the real estate. The simple ones are you the ones that we've always looked at in real estate. Where's the water level? What kind of dryness do you have? Do you have fires? Are you going to have hurricanes? Are you going to have any other? Are you in California, right? So all those elements we've looked at for 20, 30, 40 years in real estate because we cared about how they impact real estate. But now we're very much looking forward for not only what it is today, but what it can be 5 years now, 10 years from now. So it's becoming an important part of underwriting. It's certainly an important part of us being just a good corporate citizen.
And from the investor perspective, are you getting more drill down in a way on those topics from investors, or it's a part of generally assessing your managerial approach?
We are getting some from our shareholders. I would tell you that if we're meeting with 500, we have 500 shareholder meetings a year. It's not a high percentage of those meetings that we're having this discussion. But we are getting more pressure from proxy firms like ISS. And the rating agencies are actually talking about having a rating code based upon your environmental sensitivity. So it's coming. I almost think it's as if the shareholders are telling the other groups, I want you to do this for me. And then following that will be the shareholders who are starting to talk to us and who will talk to us more as time goes on. Clearly, public pension funds who own our shares are very concerned about this.
Yeah. Glenn, let me ask you a completely different question, which we ask everyone who joins us for one of these sessions, which is, and Sam mentioned, we have a lot of students. It's obviously we're a part of NYU and devoted to educating people for careers in real estate. You're a student at NYU today. You're looking to get into the real estate business. It's a different world than when you started out, and you've learned a lot of lessons in your storied career. What's your advice to students today looking to get into the real estate business, both sort of on a short-term basis vis-a-vis the pandemic, but I think more important on a longer-term basis, thinking about all the lessons you've learned and what you see out ahead for the industry in the next 10, 20, 30, 40 years?
Well, to go back to where Sam was talking about, when I went to receive the award that NYU gave that night, and Sam had just started, he was on the podium with me. It was terrific. Milton Cooper, who is my idol, was up there as well. And we were talking about education in real estate. And I actually mentioned about a fellow by the name of Edward Weinberg, who was probably two or three people removed from Sam. I don't know if you remember him, Adam, but
Sure.
he ran Schack for many years when I first started to teach at NYU, and he was very progressive, and he'd say, the guy named Peter Spies and myself, if we wanted to start a couple of courses, and then Ed would say, well, that's fine, we'll let you do that, we'll sponsor you, we'll market it, and if you don't get a lot of students, we're going to fire you. That's it. And I remember saying to Sam, if he doesn't do a good job, he's going to get fired. He hasn't been fired yet, so I guess he's
done a fabulous job. I can tell you that.
But education is a big part of where I would start. What I would start with is the education today in real estate is so far better than it was when I was joining the business, that anybody is, if you're a student, you're being educated, but don't underestimate how important that is. Get as much from that education you can in two ways. One, every one of us has a talent. We all have a talent. And, for instance, I have no talent in art. I can't draw, I can't sing, I can't do, but I have some talents in being able to manage people and look at large or difficult situations and try to make them simple. Through education in life, find out what your talent is. Where are you strong? So that when you do find your position in, let's assume it's real estate, you can be the best at what you are, because your talent will leave you there. The second is through education and the people you meet. You should be able to find a passion for something in the real estate business. Maybe your passion is acquisition because your talent is to analyze and negotiate. Maybe it's leasing, maybe it's accounting, maybe it's legal, the legal part of real estate. But through education and what education can teach you and the people you meet, understand your talent and your passion, and then move in that direction as quickly as you can. Recognize you may not get there right away. No one gets the best job they want right away, but move towards where you want to get to. And the wonderful part about our business is that there are so many positions you could have. The difference in people between a leasing agent, property accountant, or general counsel is enormous in terms of personality and talents. So we have this wide spectrum that you can choose from and be in our business. But you want to get to the best spot you can where you feel most productive, because that's how you'll grow. So find out where you want to be. Get educated as much as possible. And the education isn't only book learning, it's get out and meet people, talk to people, understand how they moved ahead, and then find out where you want to be.
Sounds like perfect advice. Thank you.
Oh, Adam, if I can jump in here.
Yeah, absolutely.
We've got a whole lot of questions from the audience, and folks can see as every week we're joined by Professor Scott Robinson, the director of the REIT Center. Before I hit on any of the questions, Glenn, just want to pass along a shout out that we got from Jennifer Carey, who I think people will know from her role as the former chairman of CREW. Just thanking you and for your role in commitment very early on to the advancement of women in the industry. And she points out in the comment that you were one of the very first CREW network visionaries.
Well, thank you. CREW is a terrific organization, and it's part of real estate education. It's educating certain sectors. We need more diversity in real estate. That's for sure. And any way we can do that will make us better. So thank you very much. I appreciate it, and we will always continue to support CREW.
Fantastic. A lot of the questions that we've got from folks are things that you've touched on already, but they're looking for elaboration. And probably the one that's really risen to the top of the list is your views and expectations on what and realize, of course, there's some speculation here, but what are likely to be the most persistent, long-lasting, perhaps even permanent changes in consumer behaviors coming out of the pandemic?
It's a very good question, and it's a question I've got on the last two earnings calls in a different way. But it's the same thing. The questions that I usually get from our shareholders are there certain property types that, because of the pandemic, you will think about exiting from over time? And I would still give this answer. I had this on the second quarter call, and I'll have it on the third quarter call, I'm sure. I've had it along the way. I don't think we know yet from the pandemic whether certain trends are cyclical or secular. And I think everybody understands it. But what I mean by that is, do we have a short-term interruption because of the pandemic that will turn, and it's just a cycle? And when the pandemic's over, and it will be over. I mean, whether it's 6 months, 12 months, 18 months, it will be over. And we're not looking for today. We're looking for 12 and 18 months from now. That's what the CEO is looking at. So it's over. Will those consumer trends, which impact the real estate, come back to life, and the real estate will be fine? Or will they be secular, which means that it's a permanent change in consumer behavior, and it's a permanent change perhaps in the real estate that those consumers are inhabiting? So I don't know the answer to that, is what I would say today. I don't know. We're still in the middle of a storm, and making a decision in the middle of a storm is a bad idea. So what we are going to do is continue to evaluate. And just to be more specific to the question, because it's very good, if we looked at our total rents, we have been collecting close to 80% of our rents, even through the pandemic, consistently. But it's because they're discount merchants, they're grocers. They are essential folks who actually have not done so bad. And if you look at where we've had the more difficult part in collecting rents, it's been casual dining and entertainment. And so now the question becomes consumer behavior. Will people stop wanting to go out and eat? I don't think so. But time will tell where they're going to go out and eat. And the important part from our standpoint is not only that consumer behavior, but how long that consumer behavior lasts. And that's the duration issue I talked about before. If let's assume the cycle will come back, but the cycle takes 3 years instead of 1 year, how many merchants can last 3 years before the cycle comes back is a big issue. And the same thing in some portions of our portfolio, entertainment, for instance, health clubs. I think people will want to be healthy, but will their habits change, and is it cyclical or secular? I think it's more cyclical than secular, but the timing is important. So I don't know about the consumer behavior change. There are some big ones, big secular changes. Clearly, e-commerce is here to stay. I mean, that I don't think is an issue. But folks like myself that are ICSE trustees, believe omni-channel is important, and there'll be a combination. And if you can't adhere to that, you'll die. This is capitalism. It's a harsh system. You either conform or you die. And so omni-channel is here, there, and that's a consumer change. And then the last one I'd mentioned, people talk a lot about office in terms of the office consumer. Will they want to consume the same amount of space a year or 2 years from now? And I don't know the answer to that. We have some offices suburban. It's a small part of our portfolio, but I'm sitting in a major office building in New York. There's clearly some change occurring. I'm not so sure I'm smart enough to know, but we're going to be watching it.
I'm going to put the same question next week. Really excited Mary Hogan Bruce is joining us.
There you go.
She's one of your board members.
Absolutely.
Mary, board member of Kimco, Digital Realty, Host Hotels. She's actively involved with ICSC. She's got this incredibly expansive view of the industry from these different leadership roles she has. So please do make sure to join us next week for Mary. It's another one of the, you can't miss it guests that we've got coming up, but also connected to Glenn. Scott, please jump in.
Yeah, thanks. Glenn, you mentioned the possibility of seeing some public-to-public mergers, starting maybe next year. Who knows? It may not happen. It may take longer. But kind of flip that a little bit. Do you see a significant amount of private assets coming to market, whether it's portfolios or one-off, or even IPOs or reverse mergers?
We Scott, before I do that, can I just say one thing about Mary Hogan, just to give you. I mean,
Yeah,
Mary
of
Hogan.
course.
Everybody should listen to Mary Hogan next week. We were looking for a person about a year or so ago to head our audit committee, and we did a little internal search, and we found a fellow named Richard Lee, who used to work for Goldman Sachs, a terrific guy. But along the way, we heard Mary Hogan, who was a portfolio manager of APG, who I've known forever. Unbelievably smart lady who understands this business well, was thinking about taking some directorships. And even though we were only looking for one, when I heard Mary, and she had just taken the directorship at Kimco, we have another board member named David Henry, who used to be the CEO of Kimco. So he let us know about it. I called her in a nanosecond, and I said, Mary, we're looking for someone. She said, well, I'm not necessarily the head of an audit committee. I said, I don't care. So instead of going to 7, we actually took our board to 8 people just so we can get Mary Hogan on the board. So she's terrific, and I may watch that next week as well. In terms of the assets coming to market, Scott, without a doubt, as I mentioned before, after Labor Day, we are seeing many more assets on the market for sale. Now, in part, I talked about debt earlier. In my view, equity always follows debt. And if the debt markets are not there, you're not going to see an abundance of equity deals. The debt markets really started to come back after the second quarter. Clearly, the bond markets did. I mean, we did a $600 million bond deal about a month and a half ago at 3.4%. And that we probably could have done that financing at 3.1% in January, February. And then it went up to as high as 4.8% in the second quarter. And then it came down pretty dramatically. And that same pattern is followed in secured financing. So secured financing became available. And I would bet that in terms of property sales, and we usually do as a country somewhere about, I think it's 50 billion a year. And we're going to be close to that for the second half of this year, for just the second half, not the first half. So I think we're going to see a lot of sales activity in the second half of the year. There's debt available, and we're seeing quite a bit of properties come to the market. You saw recently Blackstone moved a portfolio from one fund to another. Ventas just bought $1 billion portfolio. I do think in the second half of the year, we'll see much more activity than certainly what we saw in the second quarter. Will there be some public to private, private to public? It could be some of that. That's a little harder because it's an enterprise value involved in that. But from an asset standpoint, we do believe we'll see a lot of activity in the second half of this year.
We're just about out of time. Do you want to wrap us up with one more question?
Sure, Glenn. One question that we have on the audience list here is, what have you learned from your triumph and travails with SEC and lawsuits? Obviously, you came in to solve a problem, among other things. You did solve a problem. You could talk about that if you want to, but really, are there lessons for other people who aren't in the middle of that problem about how the system works or how to deal with the regulation and litigation and stuff like that?
Well, we had a number of them, and I'll go through each one. We had litigation from the DOJ, Department of Justice, and we had litigation from the SEC, two, as you know, Adam, 2 separate organizations. And then we had civil litigation, and in that we had 14 opt-out suits, and a class action suit. So we had 4 levels of litigation. And just for those who don't know, I didn't know a lot of this, nor did I care to know about it. But an opt-out suit just means a shareholder who chooses not to stay in the class and sues us directly. So we had 14 individual lawsuits, as well as a class action suit, as well as litigation from the SEC and DOJ. What we from what I would say, and I'm not a lawyer, so I'm speaking as a novice. The DOJ and SEC worked very methodically, in my view, very professionally, and we were able to work with them. The DOJ dropped the charges for the company. They did bring charges against some of the members of the old company, but they dropped the charges on the company. And we had good work with them, gave them everything they needed. It worked out fine. The SEC, eventually we had a settlement with the SEC for what I would think is not a lot of money. And they were very professional and worked with the company, recognizing the company had been suffering all along because of the civil litigation. So both government entities took into consideration in my view, the civil litigation we had, and worked with us in a very friendly manner. I did go to the SEC headquarters, which is an office building outside of the DC train station, and met with them, and I thought they were very reasonable people. In terms of the civil litigation, now that was much different. The bottom line there, this company paid $1 billion to settle the opt-out suits and the class action suit. And our litigation expenses for the 5 years that this was going on was $250 million. I can't say I had a very good view of that whole situation.
Can't blame you.
And do I think this company should have paid that much? I was hoping not, but it was what it was. And I would just tell you, once you get into the morass, if you're a public company and you do something wrong, maybe you deserve what we got. And whether we did something wrong or not is questionable, but you shouldn't even get close to it, because if your behavior isn't exemplary, you may be put in a very difficult spot, as we were. So the government process I thought was very reasonable. The civil process was much more difficult.
Thanks. Well, it's an ordeal. I'm sure you're thrilled to have it all behind you.
We are thrilled to have it behind us.
Well, Glenn, thank you again so much for joining us and for everything that you do for the Schack Institute and our students. Folks, again, join us next week. We've already had a couple of plugs for Mary Hogan. You don't want to miss that. And then in our Capital Markets Leadership Series this Thursday, we'll be joined by Tammy Jones, CEO of Basis, board member at Matt Calley, and the chair of the Real Estate Executive Council. Thanks, everyone. Look for the replays on YouTube.
Thanks so much. Thanks, Glenn. Really appreciate it.
Thank you.